This might sound strange to you, but the money you have in the bank isn't actually real money. I mean, I'm not saying the numbers you see on your banking app are completely imaginary. But if everyone suddenly went to the bank and said, "I want to withdraw my money," the banking system would collapse within a few hours, because that money simply isn't there. Actually, this isn't a mistake. On the contrary, the system was designed to work this way. It's been running on the same trick for centuries, and we've all come to see it as normal. This system is called fractional reserve banking. In short, it means banks using money that doesn't really exist. And yes, this system is the main reason behind the world's debt, inflation, and the illusion of wealth that isn't real. Back in the day, in the Middle Ages, money meant gold or silver. The rich literally kept these in their vaults: gold, jewelry, and coins. But carrying them around was both risky and impractical. So people began leaving their valuables with goldsmiths. These goldsmiths were trusted men with secure vaults. In exchange, they would give a receipt. That receipt basically said, "I've deposited this amount of gold. I can take it back whenever I want." After a while, people realized something interesting. Those receipts were just as good as gold. Everyone trusted them. So instead of carrying gold, they started trading with those pieces of paper. And that's where the trick began. The goldsmiths noticed that no one was coming to claim their gold at the same time. If 5 out of 100 customers came, the gold of the other 95 just sat there. Then they thought, "We can make this gold work." If they had 5,000 pieces of gold, they started writing 10,000 receipts. In other words, they were lending gold that didn't actually exist and charging interest on it. In short, they started creating money out of thin air. And people didn't notice because they trusted the system. That's how the idea of creating money from nothing was born. As time went on, the system grew. Goldsmiths turned into banks. Even governments got involved. In 1694, the Bank of England was founded, not for the people's money, but to manage the government's debts. In other words, the bank lent the government money that didn't exist and charged interest for it. Who paid that interest? Of course, the people, through taxes. Basically, the same thing happens today, just in a more modern form. Governments still borrow money that doesn't exist, and future generations are the ones paying for it. The same story played out in America. Banks began issuing notes that could supposedly be exchanged for gold. Then they realized no one ever asks for gold all at once. So they printed more and more. But when panic hit and people demanded their gold back, the truth came out. There wasn't enough gold. Thousands of banks went bankrupt. Instead of fixing the system, the government said, "All right then, we'll make sure you don't fail," and created central banks. In other words, they openly admitted, even if there's no real money, we'll keep people's faith alive somehow. Today, things seem different, but at their core, they're not. You deposit $100 in a bank. You think, "That's my money sitting there." But the bank only keeps a tiny fraction of it. The rest is lent out as credit. The person who borrows that money spends it. Someone else earns it, and that person deposits it into another bank. That bank then lends out most of it again, and the cycle continues. In the end, your original $100 circulates through the system as nearly $1,000, but in reality, only a small part of it exists as cash. The rest is debt. And here's the bad news. Since 2020, banks in the United States are no longer required to hold any minimum reserves, meaning they can keep as little as 0%. In other words, banks no longer create money based on what they have, but based on how bold they are. Today, what limits banks isn't the cash in their vaults, but an international regulatory framework called Basel. These rules are written in Switzerland by a group of central bankers, not elected officials, just technocrats. They say things like, if you're going to issue risky loans, you should put up some of your own capital. But the rules are complex, and the outcome is simple. Banks issue loans first and figure out how to cover them later. That means money is now created the moment you go into debt. When you take out a loan, the bank doesn't give you cash from its vault. It simply types new numbers into a computer. That money exists only because you owe it. Today, over 90% of all money in existence is debt created by banks. Of course, this system has unavoidable consequences: inflation, because the same money keeps being multiplied. The more money there is, the less it's worth, and prices rise accordingly. Endless debt. Since money itself comes from borrowing, there will always be more debt than can ever be repaid. Concentration of power. Banks earn interest on money they never actually had. Governments use this system to finance wars and spending. The wealthy who own real assets benefit from inflation, while the middle class's income stays the same. And whenever this illusion is shaken, everything collapses. 1929, 2008. Same story every time. There was no real money, only promises. And every time, the system was saved again. Because without it, modern economies can't function. Today, the US, the UK, and Europe, they all run on this same system. Keeping cash in a vault is now mostly symbolic. Everything is dictated by the Basel rules in Switzerland. So no matter where you live, the money you own is actually governed by a set of rules written by a handful of bureaucrats. Here's the truth. The system doesn't want you to be debt-free. If everyone paid off their debts at once, the economy would collapse. Because money itself is born from debt. The system only breathes as long as you owe. So, there are 3 takeaways from this story. Money is not wealth. Real wealth is your land, your skills, your knowledge, and your freedom. Debt is not neutral. The system protects the lender, not the borrower. Inflation is no accident. Even staying in the same place each year means you have to work harder. This isn't a doomsday story. It's a wake-up story. Keeping your money in the bank doesn't protect you. Blindly trusting the system doesn't make you free. Real wealth is what lies outside inflation and debt: land, skills, production, knowledge, connections. These are the things that last. Money is a promise, but freedom lives in your awareness. Never forget, this whole system is built on trust. And once that trust disappears, the numbers mean nothing. Understand the trick, and you can protect yourself. Ignore it, and you'll stay a pawn in the game.